Welcome back, you legends. Long time no see, so let's get right into it. The stock market was mostly flat on Friday. Let's take a look at the different sectors for the week. Cyclicals were leading, followed by basic materials and communication services. Surprisingly, look at tech somewhere in the middle, with energy, financials, and utilities lagging. So last week was a full-on risk-on move, meaning market participants were taking on more risk. They were buying stocks and positioning themselves for the long side to take advantage of the upside move that we've actually been seeing since the 13th of October bottom. The uptrend remains intact. And so what's going on with tech? Why is tech not leading as usual? It's because of this. Look at this, guys. This is the weekly performance of the different sectors in the S&P 500. And Apple was actually down slightly on the week. And that's off all of the bad stuff that's going on in China with the China lockdowns, as well as the protests, especially at Apple's manufacturing supplier, Foxconn. So unfortunately, this has weighed down Apple, and Apple has a quarter, look at this, a quarter of the weighting in technology. And a flat Apple meant that tech unfortunately underperformed the rest of the market. But with cyclicals leading and basic materials as well as communication services, we can tell that this was a full-on risk-on move on the weekly chart. Let's take a look at the weekly chart. In fact, everybody, boom, we bottomed right here on October 13th, and we've been chucking along, moving up slowly and steadily, forming this ascending wedge pattern. Now, an ascending wedge pattern, everybody, is a bearish structure. Ascending wedges very often end up breaking to the downside as we move closer and closer to the tip of the ascending wedge. Now, the tip comes out at the 30th of December, so we do have 4 weeks remaining before this ascending wedge is likely to break down. Now, interestingly, I have this marked as major resistance. Funnily enough, I actually marked this chart well before this rally hit this resistance line. I marked it because this resistance line has proven to be a very, very formidable line for bears. Bears usually jump on the stock market as soon as we slam into this resistance line. Look at this legend. Systematically slamming into this resistance line meant massive selling. Now, we did slam into this resistance line last week, but I do believe that this time it's going to be different. And here's why. Throughout the bear market, really since the top in January, the selling has actually been driven by a major risk, and that is the Fed tightening, raising rates. As soon as Jay Powell came out, boom, right here, November 30th, and said that the Fed is now looking at transitioning into pausing interest rate hikes or potentially slowing down interest rate hikes as soon as the December meeting, which is coming up on the 14th of December, the market rallied massively, and that was to be expected. The Fed actually hinted at that as soon as November 2nd. In fact, I talked about that on November 2nd. I said that this sell-off was in fact an overreaction, and we ended up chopping about at the lower edge of this ascending support line, and we ended up rallying as soon as that CPI print came out on November 10th, and the market rallied. Throughout this rally, everybody, decisions have been made on significant days. That includes, boom, the CPI print November 10th, and boom, Jay Powell's speech on November 30th. The next critical date to watch is December 9th, when the PPI is expected to come out. That is the producer price index, this little number right here. The forecast is 7.3%, significantly below the 8% of last month. And remember, last month we had both PPI and CPI, the consumer price index, come in significantly below expectations, and that led to this absolutely enormous rally on November 10th. And so let's quickly circle back and talk about why I believe that the market will actually take out this resistance line. And it comes back to the Fed. The Fed is now done as being a major risk to the market. I think the Fed is now not a major risk to the market anymore. At the beginning of the year, it was inflation, high yields, the Fed tightening, high interest rates. all of those were the major driving forces behind this entire bear market sell-off. Now we're transitioning into the second phase, or what I call the end stage, and it's not actually good, everybody. I do think that we will take out this resistance line, but I'm not being optimistic. I don't think that we will see a continuation of this rally or the beginning of a new bull market and the end of this bear market. Absolutely not. What I do think is going to happen is that we will take out this resistance line, form a false break top, boom, bears will step in at this top sometime this month, perhaps even in January. But I do believe that we will see the market top within the next 4 to 6 weeks. And as soon as company earnings start to come out in January, in February, I expect the market to continue to go down, with risks to the downside being driven not by inflation, not by the Fed, not by yields, but by declining earnings, by slowing growth, and basically recession fears. Now, recession fears were looming all over the place as we saw the selling to the downside, but the sell-off was mostly driven by high interest rates, high inflation. In fact, Q3 GDP was positive and it was revised higher. Boom, I'm talking about this number. It was at 2.6%. The forecast consensus was at 2.7%. And we ended up revising the Q3 GDP growth to 2.9%, so even higher than forecast. With all of that being said, I do in fact suspect that next year we'll see GDP come down significantly for at least 2 to 3 quarters, and that will drive the next sell-off to the downside. The next major risk being weakening earnings, weakening growth, global recession, and basically all of this tightening that we've seen throughout this year. All of it we will not see the effects of it until sometime in the second half of next year. And so by the second half of 2023, I do suspect that we will go significantly down to my target of at least 300 on the S&P 500, all the way down to boom, the pandemic lows at about $240 to $250 by October of next year. Now that's my forecast for next year. What about next week? Let's take a look at the economic events that we have coming up next week. We have the ISM Services PMI coming out on Monday. Tuesday, we'll have the balance of trade. Wednesday, nothing really happening except for a non-farm productivity release, as well as a labor costs update at 8:30 a.m. Eastern Time. Thursday, initial jobless claims, an update to the initial jobless claims. And Friday is going to be the big number that everybody's waiting for, and that's PPI, as well as the Michigan Consumer Sentiment Index. Now December is interesting because we tend to see the CPI, usually we tend to see the CPI come out ahead of the PPI. December is an exception, and so I do in fact suspect that we'll see a massive move Friday, December 9th. And so far I'm leading towards a move to the upside, and that's because of this. Let's take a look at this chart, everybody. This is the monthly chart for the GSG Commodity Indexed Trust Fund. It's basically an ETF that tracks commodity prices. And look at this, November, let's take a look. Boom, we went down, boom, 0.8% in commodities. And so commodities tend to feed directly, commodity prices tend to feed directly into the PPI. And based on what I've also seen from companies like Costco reporting significant declines in November sales, I do suspect that we will see PPI come in lower than last month. I'm not sure if it's going to come in lower than expected, because the expectation, look at this, PPI year over year, 7.3%. That's 0.7% below last month. That's a significant decline in the forecast. And so while I do expect PPI to come in lower than last month, I'm not sure if we're going to miss or beat the forecast. Regardless, I think inflation is coming down, and I'm not seeing really any major risks to the Fed that will force the Fed's hand to raise interest rates any longer beyond December this year, beyond the December 14th interest rate decision. We will not know for certain until December 14th as the Fed announces their interest rate decision for December, which has now been taken down from 0.75 to 50 basis points. And the market is enjoying that. But much more important than that, everybody, we will need to watch the Fed press conference as well as the interest rate projections for the terminal rate. Now, the terminal rate is expected to top out just under 5%. And that's why yields are declining. And as yields decline, the stock market loves to move to the upside. The PE ratio, price to earnings ratio, on the stock market becomes more attractive. And so more money flows into the stock market. And that drives the PE ratio up. Valuations go up. Even if earnings stay flat, as yields go down, stocks will move to the upside across the board, driving that everything rally that I've been talking about for weeks and weeks and weeks. Now, I do want to talk about something else that's very interesting, and only the keen-eyed among you will have noticed this. Now, this was last week, the 5 trading days of last week. And if you notice, guys, look at this. November 28th, Monday, we were down. Look at this. Tuesday, we were down. Wednesday, we were up massively. Boom. Thursday, we were down. And again, Friday, we were down. So out of the 5 trading days, we had the entire week's trading activity come in on, or the action, I should say, come in Wednesday after Powell's speech. And the rest of the week, the market was actually down. It closed down versus the prior day, 4 days out of the 5. And unfortunately, this tells me that big money is actually dumping positions. Now, that is strange to say because I do expect the market to continue to grind up, but throughout this grind to the upside, I do suspect that big money, smart money, money that's been holding stocks for years and years and years, to continue to scale out of positions as the market begins to top. Let's take a look at the triple Qs, the NASDAQ. The NASDAQ, same thing really on the NASDAQ. We had boom. Monday, Tuesday we were down, Wednesday we were up, Thursday we were basically flat, and then Friday we were down once again. Let's take a look at the relative strength chart. This is the triple Qs divided by the S&P 500, the NASDAQ relative to the S&P. Down below is the S&P 500. And what do you know? We're now establishing a new uptrend in this relative ratio chart, exactly like the uptrend that we saw back in the May bottom and the June bottom. Look at this. The ratio bottomed in May, and then the stock market ended up bottoming in June, and we established this nice uptrend throughout July and August, topping in early August for this ratio and topping in mid-August for the S&P 500. So why is this important? Well, if you notice, guys, look at this. The ratio topped August 4th, and the S&P topped August 16th. So the ratio chart gave us a heads up that the market is topping. We've not seen that quite yet. And so we could still continue to see the market continue to rally as this ratio chart continues to grind to the upside. Again, I do suspect that the market will top sometime in the next 4 to 6 weeks. And so if you're looking to short the market, I would hold off for now. I do suspect that we will see more upside in the next several weeks ahead of those earnings reports that will be coming out in early January into February. And so why am I tracking this? Well, this is another proxy indicator for risk taking in the market. And what does that mean? Well, if the market is moving to the upside, you will see a lot of money flow into risky assets. The S&P 500 is considered a risky asset. The NASDAQ is considered an even riskier asset because it's made up of a lot more growth-oriented tech stocks, while the S&P has some value stocks, some energy, a lot of utility stocks, and so on and so forth. The NASDAQ is more weighted towards the risky growth type of names like Tesla and so on. And so this is an important ratio to look at to gauge how much risk appetite there is in the market. And so far, we're seeing a risk appetite continue, even though the stock market, the S&P, has made a significantly higher high versus November 16th. This ratio chart hasn't yet made a higher high versus November 16th. I do suspect that we will in fact see a higher high, so I'm not worrying too much about this divergence as of now. What will worry me is that as soon as we see this ratio chart break to the downside, or when we see this ratio chart top ahead of the S&P, exactly like what happened back here. Ratio chart tops, S&P tops a week later. So far, none of that. We're still in a bullish uptrend. We have established a very nice support line. Now, the slope of the support line is exactly the same. In fact, I just copied this support line and I pasted it right here, and we had the exact same slope. And so we're seeing some signs that the market wants to take some more risks. Where the S&P might top, I'm not exactly sure. I'm not willing to make a call on where the S&P will top, but I do suspect that we will see the S&P fail to take out this high, this August high. We might see the S&P rally to 420, maybe slightly higher than that, maybe slightly lower than that. But I do think that the S&P will fail to take out the August high, and a break down out of this, the ascending wedge will confirm a top for me, as well as other breakouts, including in the dollar index and the 10-year yield. Now, the 10-year yield is approaching a medium term or short term, I should say, support level, and that's 3.5%. A more important support level for my eyes on this chart is, boom, down here at just over 3%. I do suspect that yields will continue to move down to around 3%, 10-year yields specifically, to continue to move down to about 3%, and bottom somewhere around 3%. I expect the dollar index will continue to move down. We have now tagged an important support level, and that is 104.5. So I do expect that the dollar index will try to stick around this level leading into the PPI. And if the PPI comes in below expectations, boom, I expect even more weakness in the dollar index. That will continue to fuel the rally in the S&P. Let's take a look at another chart. This is the Dow Jones Industrial Average ETF. And very interestingly, we've never had a look like this throughout 2022. And that is, the Dow Jones is continuing to rally, even though momentum has now crossed down into bearish territory. We haven't seen that. Usually when we see a cross down into bearish territory, that would mark the top in the S&P and the down simultaneously. In fact, let me add the S&P on here so you guys can see what I'm talking about. Boom, we had the top here. We had the cross down just a few days later. Boom, top here. We had the cross down just a few days later. Boom, top here. We had the cross down just a few days later. Now, we've already seen the cross down on the Dow Jones as it continues to grind its way to the upside, potentially eventually forming somewhat of an ascending wedge, very similar to what we've seen on the S&P 500. Now, I do want to point out that the Dow did in fact take out this significant resistance line, boom, right over here after the October CPI report came in below expectations. Now, this does not in any way confirm that the bear market is over and this is a new bull market. I do not think so at all. But I do suspect that a lot of people, a lot of market participants, hedge fund managers, so on and so forth, will continue to be tricked into piling money into a market that's topping and in fact getting ready to get crushed next year as earnings collapse globally. I'm talking about a global deep recession driven by the steep, in fact, one of the steepest, if not the steepest, rate of interest rate hikes we have seen in half a century. Now let's take a look at the smart money. Up top is the smart money, down below is the dumb money, the S&P 500. Interestingly, we have now made a 3 consecutive lower highs on the HYG. Now, this would confirm a negative divergence to the downside if the S&P rallies again, touches this resistance line, and if the HYG, the smart money, fails to take out this prior high on November 30th, that would confirm a negative divergence. And these negative divergences have consistently played to the downside pretty much every time we've seen these divergences come into play this year. Boom, we had a negative divergence here. The HYG failed to make a new high. The S&P made a new intraday high. The next day we had this significant sell-off. Boom, again, consecutive three lower highs. The S&P continued to grind up as the smart money was selling. Boom, we had another sell-off ahead of the CPI print. And so for next week, I'll be watching for another high on the S&P as the HYG fails to make a new high, leading into that PPI print on Friday. And then I'll be watching for a break to the downside, very similar to this break to the downside November 9th, very similar to this one on November 2nd. And at that point, if we sell off ahead of PPI, I'll be more bullish, because really ahead of every major bullish event, news event, economic drop, etc. this year, or I should say specifically this past month in November. In fact, look at this. This was November 10th, the CPI day. The market was bearish ahead of the CPI day. It was pessimistic. That's what you want to see. You want to inverse the market. Again, November 29th, ahead of Powell's speech, the market was pessimistic. That's what I want to see ahead of PPI. I want to see a pessimistic market. If you're bullish, that's what you want to see. You want to see the market sell off. You want to buy into that weakness. If you want to front run PPI, which I would not recommend, I do not usually like to front run significant economic events. But that's what you want to see. You want to see a sell-off. You want to see this ascending wedge, the support line hold. November 8th, boom, we tag 404, something like that, maybe 403. And then the market, boom, rips to the upside, hits the this upper resistance line at 415, creating a $10 move in a single day. Now, with that said, with all of that being said, the weekly expected move for next week is 400 to the downside, 413.5 to the upside on the S&P. And so again, if we see weakness in the market in the beginning of the week, in the middle of the week, that takes us down closer to the weekly expected move, has often been a good entry to go to the upside. If you're bullish, boom, we sold to the downside, down to the weekly expected move, the market recovered, boom again, weekly expected move, the market recovered, so on and so forth. Let's take a look at the VIX. The VIX now has not only filled this gap that I was looking at, it created a double bottom and then it broke down to the downside. Now we're at 19. We haven't seen a reading on the VIX this low since the April top. In fact, I suspect that we will even take out 19 and go even lower than that. There's no VIX sell signal on the chart just yet. I'm still waiting for a bullish crossover on this chart and for volatility to actually start building up for several days, up to a week ahead of the market topping and the S&P 500 selling off. This is the S&P 500 down below. And very, very often we end up seeing the VIX bottom just a few days ahead of the S&P 500 topping. We had the exact same thing. Boom, here the VIX bottomed. Boom, right here the market is up, selling off just a few days later. Again, right here the VIX bottomed and the S&P 500 ended up selling off. We haven't seen a bottom yet. I'm still waiting for a bottom on the VIX to confirm a VIX sell signal. I suspect that we will see that sometime in the next, again, 4 to 6 weeks. Let's take a look at another chart. This is the Dow Jones Industrial Average up top. Down below is the Dow Transports. And would you look at this monstrous divergence? The Dow Jones Industrial Average has taken out this high. Now, in fact, we haven't not just taken out this high, we have now effectively taken out this high, the August high on the Dow Jones Industrials, while the transports have failed to do that. Now, I've been tracking these divergences for several weeks now. This is not a great market timing tool. In fact, it's a very poor market timing tool, because if you track this divergence and you called a top in the Dow Jones, boom, when we had this divergence right over here, industrials made a new high versus this high in September. Transports failed. If you actually shorted the market there, you will have lost a lot of money. And so this is not a great market timing tool, but it's important to look at because it does predict future trend changes. And so far, the Dow Transports are confirming so far a change in trend to the downside is coming eventually. When, we don't know just yet. I'll be more willing to call the top as we get the bottom in the VIX sell signal, as well as the smart money confirming a top, none of which have confirmed the top just yet. Let's take a look again. Let's take a look at another chart. This is the XLY, consumer discretionary, divided by XLP, consumer staples. And what do you know? We had a double bottom. Boom, right here we held. We have a significantly higher low on the PPO. This indicates a bullish divergence that indicates that consumer discretionary, i.e., risk taking in the market, is now going to accelerate, allowing the market to rally even higher. This black and blue chart, everybody, is for AMC. I do like to track meme stocks because they tend to rally closer to the market top. In fact, let me add the S&P 500 on this chart. This up top is the meme ETF, which includes a lot of the meme stocks. Down below is the S&P 500. And what do you know? Look at this. Meme stocks topped, the market ended up topping. Boom, we had another one here. Meme stocks topped, the market ended up selling off. And another one right here. Meme stocks topped, the market ended up selling off. And so I do like to track meme stocks because they do tend to rally closer to market tops. And as the market begins to hammer out a top in the next, again, 4 to 6 weeks, I do suspect that AMC will rally to the upside. GameStop, I expect GameStop to rally, and I suspect that Bed Bath & Beyond will rally. Now, full disclosure, I did open a long position in Bed Bath & Beyond. I used options to leverage my position. I opened a tiny position because please be aware that if you put money into things like this, like meme stocks, do not put more than what you are willing to lose, because these are the riskiest assets in the market. And it's pretty bad idea, pretty bad trading hygiene to play around too much with these stocks. Position your size correctly. Please manage your risk accordingly. Now, I do have a long position in Bed Bath & Beyond, and I'll show you exactly why. Boom, number one, XLY to XLP has bottomed and it's moving to the upside. Meme stocks are now rallying. AMC is beginning to rally. The meme ETF is beginning to rally to the upside. And more importantly, something very specific to Bed Bath & Beyond. Look at this now. Boom. What do we have? We have a close above the 20-day moving average. When was the last time that this happened? It didn't happen here. It did not happen here. It did not happen here. Oh, look at that. It happened right over here. And what happened after that? Well, you can see for yourself, Bed Bath & Beyond rallied like crazy. And in fact, I did actually participate in this rally, and I did post about it in the YouTube channel. I made, I think, over 140%, something like $150,000 trading this stock to the upside using stocks and options both. And I'm now anticipating that we will see some more FOMO, fear of missing out, some more gambling, some more risk taking as the market pushes from greed into extreme greed over the next, let's say, again, 4 to 6 weeks. And so this is a significant development in my eyes, this close above the 20-day moving average. This does not mean that Bed Bath & Beyond cannot go back down, form another triple bottom formation, something like that before rallying. It happened back in July. Alternatively, it can just continue to push to the upside. Now, the second significant development that I'm now waiting for is this. Look at this, everybody. We need to see the 9-day. The 9-day is this blue and yellow line. We need to see that the 9-day cross above the 20-day, and we need to see the 5-day cross above both. Let's take a look at what happened here. We have the 5-day. It has crossed above the 9, but the 9 hasn't yet crossed above the 20. And so as that 9 crosses above the 20, the 5 crosses above both, that will trigger a lot of scanners. A lot of scanners will be triggered once that happens. And that will, in my assessment, trigger another massive rally to the upside. Now, my upside target is just under $13. And that's because of the Fibonacci retracements, as well as this significant boom prior support, which I now suspect will act as resistance. So I do suspect that the Bed Bath & Beyond rally will probably stall right around 13 bucks, perhaps a little less than that. We'll see. But that's a significant rally. Even if it just goes to 7, that's a 100% rally to the upside. And if you leverage using options, again, please manage your risk accordingly. If you leverage using options, you could make anywhere between 5 to 10x your money. So again, full disclosure, I do have a position in Bed Bath & Beyond. It's a tiny, tiny position. In fact, I'm willing to see this position go to 0 if this thesis goes down the toilet, which is a real possibility. Please keep that in mind. But I'm only risking what I'm willing to lose, and it's a tiny, tiny position in case meme stocks continue to rip to the upside and based on this close above the 20-day moving average. Let's take a look at Tesla. Now, interestingly, Tesla was forming this descending wedge pattern, this bullish descending wedge pattern. And in fact, in the Money Time Machine trading community, by the way, check out the link in the description if you're interested. I do post every single trade and investment as well as live daily stock market, pre-market, intra-market, and post-market analysis, as well as interpretation of economic data and a whole bunch of cool stuff in the trading community. If you're interested, please check out the link in the description below. We do have a 50% off Black Friday deal that ends today. Yes, Sunday. This is going to be the last day, so please take advantage of that if you're interested in joining our legendary trading community. Now, with that said, I just wanted to say that in the trading community, personally, I did scale into Tesla. Boom, here and again, boom, as we tagged the lower support line for this descending wedge. And now Tesla does look like it is forming an inverse head and shoulders. And I do think that this week we could see Tesla retrace back to just above 185, perhaps 186. Tag the 20-day moving average. That would be a nice entry if you're looking to go back into Tesla. In my opinion, that's just my opinion, everybody. That will confirm a inverse head and shoulders, a bottom, and a full measured move on this structure would take Tesla, let's see, boom, to just under $248, which is a prior top. So that's a very nice risk to reward in my opinion. This is another chart that I look at. This is Tesla relative to the triple Qs, and it's been flagging. Unfortunately, it's been flagging, forming a bear flag / a bear pennant. So we could see Tesla break down to the downside, form a double bottom, and then rally to the upside. This is Tesla relative to the triple Qs. And that could allow, again, for that nice dip buying opportunity in Tesla. Now, that could happen, or simply Tesla could just continue to wedge and rally to the upside. We don't know just yet, but that's just a possibility. If it happens, take advantage. If it doesn't, just there will be plenty more opportunities out there. Another chart that I like is this. Up top, everybody, is boom. Up top, everybody, is the S&P 500% of stocks above the 200-day moving average. Down below is the S&P 500. And so I track this breadth indicator to see if there's confirmation for the rally. And so far, yes, we've seen higher highs, boom, and higher lows, even though momentum has been slowing down. Again, wedging very similarly to what we are seeing in the daily chart on the S&P. Momentum did cross down. We could see, boom, one final push on momentum forming. We could see one final push as momentum tries to cross back, or perhaps just tag this descending orange line, something like that. A negative divergence, no high, lower high, and a sell-off will ensue in my assessment. Let's take a look at another chart. This is the McClellan volume summation index for the New York Stock Exchange, and I do track this chart to find or to identify major changes in direction or trend. When the black line crosses below the orange line, we tend to see major changes in direction. Look at this. We had to cross down. The market ended up selling massively to the downside. Another one, boom, here, sell off, and another one, boom, here as we cross down. Significant sell off. We haven't seen that quite yet. Again, indicating that no, the top is not in quite yet, but we will likely see that coming in the next month or so. Another new indicator that I'm actually working on that I haven't discussed just yet is another form of the put to call ratio. This is the total put to call ratio. This is a slight variation on the prior CPC buy and sell signal. This is a new chart that I'm looking at, that I'm working on, a new signal. And actually, I'm going to use this to time the top. And here's how I'm going to do it. This green and red line is the 5-day moving average on the PC. And I'm going to wait for a tag of this support line. Boom, because every single time we tag this support line, we actually had the market sell off massively. In fact, interestingly enough, it marked the top exactly on the day. Look at this. I haven't seen an indicator this perfect in ages. Look at it. It marked the top exactly. I swear it's like having a time machine. Boom. Again, look at that. A perfect tag of the top. And I'm going to wait for a tag again sometime later this month to catch the top and go short yet again. I'll be making a video on how to set this new signal up in the trading community. Again, check out the link in the description below if you're interested. Let's take a look at the fear and greed. Greed 63. I do expect that we will see extreme greed sometime in December. Boom, we are now trading above the 125-day moving average. In fact, we're trading above the 200-day moving average. But as I've discussed many times in my prior videos, if you trade above the 200-day moving average, it does not confirm in any way that the bear market is over. What you want to see is that the 50-day moving average needs to cross above the 200-day moving average. This green line needs to be above this dark blue line. That is the only way for the change in trend to take effect. In fact, let me show you what happened back in the 2000 to 2003 bear market. The internet bubble bear market, it's back here. Boom, let's take a look at the daily. And I just wanted to talk about this nasty trap. Now look at this. The S&P 500 tried to cross above the 200-day moving average. It failed after putting in a major bottom in late 2001. A rally to the 200-day moving average. Boom, failed. It then went back to the downside. Boom, created a double bottom with a positive divergence. A new rally. Oh no, the bear market is over. Buy. Rah. We crossed above the 200-day moving average. The 20-day crossed above the 200. And then just look at that. Look at this. Absolute failure. The 50-day moving average came very close to trading above the 200 and it failed. And what happened? Well, let's take a look at what happened. Look at this. I mean, that's insane. Look at this sell-off. Look at this absolutely insane sell-off. And yes, absolutely, I expect this kind of selling to come next year. Absolutely, I expect a waterfall crash sell-off to come in 2023 when everybody realizes that inflation is not the risk anymore. It's the massive recession/depression that is coming as a result of the rapid rise in yields and interest rates globally, not just by the Fed, but globally. Now, the bottom did not come until, boom, right here, a double bottom. The market bottomed October. A year later, we had the crossover finally happen in May of 2003, and that confirmed the end of the bear market. We had a triple bottom, in fact. So even if you missed this bottom, you had another chance to enter and to catch this beautiful rally to the upside that lasted well over a year. Now, stock price strength is moving to the upside, breadth is moving to the upside, put to call ratio is wedging to the downside. This is the chart that I'm talking about. We are now seeing somewhat of a wedge to the downside, this contraction in the put to call ratio. As it continues to decline, I suspect that we will see it hold this bottom and trap a lot of people, unfortunately, and just absolutely destroy the Johnny-come-lately bulls. Market volatility continues to move to the downside. I suspect market volatility will continue to inch its way downward and form a bottom sometime this month. Safe haven demand is now declining. More risk-taking means more buying of stocks and more buying of high-yield bonds, i.e. junk bonds. Same thing, boom, in this chart. So next week, everybody, in summary, not a lot going on in terms of economic events. We do have PPI coming in on December 9th, the first time where the PPI will be coming out ahead of the CPI. CPI will come out the week after that on December 13th. and the Fed will make their interest rate decision on December 14th. So a lot of risks ahead Friday, as well as the week after, Tuesday and Wednesday. Again, I do expect PPI to come in below last month's reading. Watch for a lot of weakness in the S&P 500, a lot of choppy trading weakness, especially Thursday. I do want to see a sell-off Thursday, something that looks like this, for me to feel more confident that the market will react positively to PPI on Friday. If we don't see that, if we see the market boom, 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 continue to rally and tag this upper resistance line out of PPI, that will make me way more nervous to go long. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.